Welcome to another episode of M&A Blueprint. My name is Denis Mezheritskiy. I am an M&A advisor. I help clients buy, sell, value companies. I have my partner in crime here, Nick Stehr, who's joining me again for another excellent episode on how to make it in the M&A world. We have an excellent guest for all of you guys today that I'm extremely excited about because I wanted to get somebody in that private equity a world in on the podcast just because Australia is such a different market, and it's Peter. How do I pronounce the last name? Peter Scrine.
Scrine. Yeah, Scrine.
Awesome. Well, welcome to the show.
Thanks, gents. Nice to be here.
Yeah, great to have you. Good to see you, Peter. It's nearly a year ago since we met, I guess, and we got chatting about different things. We're at an awards night of all places, and happened to be lucky enough to sitting next to your good self. But we started this program with a vision to try and. One of the things I've noticed lately, and I think you and I spoke about this, is that mergers and acquisitions seems to be the hot topic in business. Everybody's talking about buy and builds and things like that. And so, not the least of which is certainly private equity now. When you look at the sheer number of firms that are out there and funds that are being, funds that are being raised. And we thought it would be good to sort of put together a resource like this that speaks to people that are maybe not yet ready, but are looking for an avenue to try and build their business and self-educate, because it's not easy, right? And there's certain sizes of businesses, certain sizes of private equity firms that as well that operate in different tiers of the market. And so, private equity is one vehicle for people to be able to look to build their business to a certain size.
I get to celebrate my 19th anniversary in about 3 weeks.
Oh, wow. I've been doing this for 21 years now. So we're neck to neck, Peter.
We're neck to neck there, Dennis. Yeah. It doesn't feel like it. It's in some respects, and then in other regards, I look in the mirror and I go, yeah, it's been 19 years at least. So Crescent Capital Partners, we're a founded private equity groups here in Australia. As I said, founded back in 2000. The DNA of the firm is very much wrapped around the strategy consulting heritage. So unlike a lot of our peers here in Australia that came out of the finance investment banking world, our founders were from the sort of McKinsey, Bain, LEK, BCG heritage. And the strategy behind building the group at the time, which perhaps today is a little bit more common sense, but back in 2000 was quite unique, was this idea of being able to deploy capital into a private company, but then be able to roll your sleeves up and have that strategic consulting sort of skill set to work alongside leadership teams to help them think through and execute on growth, productivity, profitability, corporate governance, financial structures, etc., and be an active investor. So really, really be a co-partner in the building of the business. And so that was how we sort of started the business. And now here we are, some 25 years later. We've moved out and we've raised over 7 funds now. We're sort of a bit over halfway through our 7th investment vehicle.
Congratulations.
Which is kind of good. And to give you a quantum of size, which it's a 1 billion Aussie fund. In true sort of private equity style, the first fund was 25 million, full of family, friends, and fools.
Yeah.
And then
I like that.
second fund 100, third fund 400, and of course it kept growing thereafter as the success of the organization became sort of renowned. Over that time, we've made 54 portfolio or cornerstone investments, several hundred bolt-on acquisitions associated across that portfolio group. About half of what we do is in healthcare and healthcare services.
Yeah.
So it's a big thematic that we pursue and have become quite renowned in as far as being active investors in the healthcare sector. But the other 50% of the portfolio has been very thematic. It's been very driven around the economic cycles and the themes that we've seen occur here in Australia and New Zealand. Because of the strategy heritage, we tend to think about these themes over 8 to 10 year horizons. So we're looking at the longer term trends and trying to find the sectors and the subsectors that make sense, with those sort of tailwinds, or disruptions, or sometimes there've been cycles. So the construction infrastructure cycle, we sort
Hmm.
of we play
Right.
against those themes.
Right.
So yeah, so it's been
Do you feel like the size with a $1 billion fund? Do you feel like the size of the market is appropriate for the amount of deal flow that's coming in right now? I would imagine that you are right now at the high level of deal flow, but maybe give
mm,
us feedback on where do you feel that is? Because I mean, obviously, when if I'm comparing, and I'm always trying to compare to the U.S. market. I mean,
okay.
that's really the bread and butter for what I do. It's a humongous market and it's very fragmented versus a little bit
Yeah,
tighter market in Australia
sure.
and New Zealand. So do you find the right now being a peak of the market? And give me some ideas on the deal flow.
Yeah. Okay. So one of the certainly in the earlier days, one of the unique aspects of Crescent was that we were very heavily driven around our own proprietary deal generation.
Right.
So probably up until about 10 years ago, 70% of what we did was this proprietary work, where we would look at would take a thematic view on a sector. We would then break it down into the value added segmentations, and then we would go drilling into the bits of the market that we thought were interesting to build out a list of companies that we thought were reflective of our interests,
Hmm.
and then cold calling, using advocates to sort of get through and in front of people, and eventually, hopefully, sort of having a conversation with someone and potentially making an investment. As to your point, as our fund sizes grew, and once we got to about 800 million and above, the shall we say, the sophistication of the leadership teams and the ownership structures of these companies sort of shifted more to where they were using intermediaries for advisory support, whether that be initially around audit and tax and strategy, but then ultimately that moved into the sell side of the business for them. And so we've found over the last decade that 70% has probably declined now to sort of closer to 40%. So
Hmm.
we still do a degree of our own origination work, but we are definitely more, whether you want to call it relied or dependent upon the sell side advisory community
Right, because
in all its.
at the $1 billion size, you can't buy smaller size company. You have to increase the
Yeah,
size of a transaction,
correct.
and then ultimately these already come in with the QOV that's already done and
That's right.
everything that's already been prepared to actually bring
Yeah,
the company to the market.
yeah. And
Which
to give you an order of magnitude, that's probably enterprise values that run from probably as low as about 100 million EV in Australia, because we will probably on a minimum scale on a $1 billion fund, the lowest equity check we tend to write is about 80 million.
Mhm.
And then that EV range will go all the way up to about 500 Australian EV.
Yeah,
So again, because we'll write maybe up to $150 million check size, and then we'll have co-invest alongside our LPs, and then
yeah.
there'll be some debt, and before you know it, and then if you're only buying a half stake in an organisation or more, then 500, 600. It's not hard to get to those numbers. But to your point, a business of that valuation and that size is much more corporatized and therefore has far more
That
support from
that that
ancillary
ma-
services.
that makes absolutely sense. I'll tell you why I like Australian market, and maybe you can tell me if I'm wrong or if I'm right. But what I like about Australian market is because of lack of funding for smaller size transactions. The
Yep.
smaller size company, if I'm doing a buy and build, for anybody out there that's thinking potentially of doing a buy and build,
Yep.
the multiples of EBITDA, if we were looking at just a regular valuation on the multiples of EBITDA, are half of what they are in the United States. I believe that's because of the lack of funding opportunities in Australia. But it sounds like when the company grows to a significant level, those
Yep.
multiples are, they go head to head with the US,
Yep.
which brings in that huge arbitrage that is available in Australia and New Zealand market, which really is not available in US, because in the
Yeah.
United States, you can buy a company, you can buy $1 million company with 10% equity
Okay.
injection,
Yep.
with using all the government subsidized loans structure.
Okay.
So I feel like that's why I feel the Australian market for anybody who's looking to do buy and build is a
Mm.
phenomenal opportunity. But tell me if I'm wrong or if I'm right.
Look, it's fair to say the Australian marketplace, certainly from a private equity venture capital standpoint, isn't as concentrated in terms of the number of participants in the marketplace as we do see in the US. Um, and you're right, the market size, of course, is smaller. I mean, Australia is like 25, 26 million people,
Right.
so it's not a massive market. And so subsequently, yeah, there's been debate about what is the actual scale of the infrastructure of the ecosystem in private equity world that could be supported. Um, we like it the way it is, but there's probably, in all honesty, there is more headroom for more participants. What we have seen over the last, certainly since post-COVID, is a much stronger influx of US and European private equity participants
Yes.
outside of the gorillas of the game, the TPGs and KKRs that have always been down here with teams. But what we're starting to see now is more of those larger upper mid-market players starting to come into Australia to look for opportunity because of the obviously the benefit of foreign exchange, the
Which is
multiples are much
huge,
cheaper.
huge benefit.
You know, the Australian marketplace from a governance point of view, the regulatory environment, the stability of the economy, the predictability of the political system to a degree,
Yeah.
the ecosystem that wraps around all of that is by and large, very favorable for investing in and sort of building out businesses of scale and creating, just best of breed companies. And then what tends to happen, and this has been our history, is that when you go to divest those businesses, more often than not, you are selling them either to an international strategic who needs or wants a position here in Oceania, or it is to a USPE who might have a network of the same organization in the US, radiology or something, and again are looking for a new territory to build out that story. So the opportunities from a owner of a company to divest is also very good. There's lots of interest in this marketplace, so you tend to build a business with a higher degree of confidence that the divestment is going to find an owner, and therefore you achieve your outcomes that you're seeking.
Would you see that, Peter, across the range of different enterprise value in terms of size of business? So what you've just said there in terms of finding that buyer at the
All right, yeah.
so finding that buyer, is that consistent across the different range of sizes of business that you see, or is it?
Ooh, good question. I look, obviously the lower end of the mid market is definitely I wouldn't say harder. You've got to have a business that's got a little bit more sort of secret sauce or a bigger moat around it to prove its worth, that
Mm,
it's an attractive proposition. Whereas a larger entity with more robust earnings and an EBITDA's north of 25 million and above, again, are just appealing because it sort of step changes other companies,
Mhm.
and the arbitrage that they get on that valuation, and if they're a listed entity, the benefit it gives them to their overarching share prices and so forth are definitely not necessarily easier, but certainly more gets a bit more attention.
yeah, yeah, for sure. What would you say people don't understand about private equity? I had a conversation briefly with someone the other day talking about what I'm working on, and
Yep.
and they're like, "Oh, you got to be careful with private equity." I'm like, "Gee, it feels to me like an old experience."
Yeah.
I don't
Yeah.
know. What do you think people don't understand about your space now?
It is funny because it's the old barbarians at the gate routine has
Yeah.
back in the 1980s. So you think that's 40 years ago that book was sort of come to market, and that
Great
sort of
book.
buy and break behavior was very much the go. Today when you look at the bulk of private equity practitioners, it's very much wrapped around this value creation, working alongside and building, benefits with the teams. I think it's just the unknown unknowns. The press, like everything, the press love to pick up on all the disasters that have occurred in private equity, or things of that nature, and so they just presume that the whole industry works on the same basis.
Mm.
That they buy in, they strip out assets, they screw over management teams, and then they run to the exits as fast as they can to try and before anyone sort of sees what's really going on here.
Right.
Yeah, we've we've taken a very much this buy and build approach, and that's been the basis of our organization since the day we started. And we're very fortunate that we sit as a top quartile, and in fact, the last two funds sit as a top decile returns to our investors. So we're talking north of 28% DPI, and that's come very much from this buying in alongside these leadership teams, working hand in glove with these guys to think through and execute on strategy, deploying our dark arts of strategy consulting. Plus, we have another suite of other value-added services that we put into these organizations to create something that's actually really unique and and has got all the merits around what you're looking for to get the upper end of the valuation spectrums that we're chasing.
Yeah.
So you've really and so it's counterintuitive too, because I still go out and speak with companies directly, and to your point, Nick, there's still that little bit of fear in their eyes, and that
Yeah.
checking my watch when you're shaking my hand sort of routine, because I'm make sure I've still got it, and and so you still go through a lot of convincing, and there's so much material out there to support this proactive behavior, and we spend our life sort of trying to advocate that we are the good guys, that we're not here to destroy you.
I think in
Yeah.
general, there's two groups of private equity. There's the ones that are trying to take over, the turnaround companies that
Yes.
maybe not
Yep.
performing, and
Yep.
a lot of the times you do got to strip out a lot of different things and separate it. And there's companies not always thriving. What you described to me is what we always look for in the roll-ups. Is you want to buy good companies from
Yep.
good people with
Yep.
good processes and procedures in place, and just help improve it. If I may ask you now to move maybe the conversation into the deal structure, I'm
Okay.
extremely curious to learn at the level of the fund size that you are operating at. What is that deal structure that you see? In a smaller size transaction, I see the deal structure is a lot different than it is in the United States. But do you like rollover equity? Do you require seller to roll over equity? Do you like what is that deal
Yeah.
structure looks like in your
Yeah.
fund?
Okay. So look, ideally we seek, I mean, in our current portfolio of businesses, we've got positions everywhere from 40% all the way through to essentially full ownership and control. So we tend to focus more on alignment of interests and
Mm,
strategy, so long as we cross that first hurdle, which is deployment of sufficient equity into the deal. Now, we tend to take a view that if we don't have control, actually, even when we do have control of in the share structure, we always ensure that the shareholder agreements have all the right balance around negative controls and levers, and so that way, whether we're 40% or the founding partner is 40%, that way there's always those checks and balances to ensure that there is a collaborative, balanced, I guess, view of how we're going to go forward. Our preferred position, of course, is somewhere in the order of around 60, 70%,
right.
particularly when we're dealing with founder owners, because we still like to keep them engaged in the business. So our most recent transaction, three founders, they were looking to divest, 80% of the business. One of those three was a very aged shareholder and was looking to completely leave the business. The other two guys were in their sort of call it late 50s and still had plenty of interest and momentum. But through this transaction, they would have been quite minoritized, and we just didn't want them to feel any lack of engagement in the business. So we actually drag them back to what we call 30% of the company, so that they actually had a reason to get out of bed and
Right.
sort of work hard for. Now, they showed plenty of passion and interest, but we've just learned over the years that unless there's sufficient to fight for or to want, then you just sort of lack a little bit of motivation around, at the end of the day. So we're very flexible. We don't try to come to the table with a prefix view of what a structure needs to look like. I guess we sort of bring it all together. Our sort of view is that this is like a marriage. This is going to be something where we are together for somewhere between 4 to 6 years, and therefore we want to ensure that in 6 months' time, when we're still sitting around that board table, that we're not fighting, that we're actually,
Yeah.
enjoying the journey with each other.
What's one thing that a founder could say to you that would kill a deal?
Ah, well, one of the biggest things that is that I think honesty is a big part of this in terms of coming into a transaction from both sides, and clarity around what we call the why of why the founder is wanting a private equity partner and what are they solving for. And where it tends to fall apart, and we've had this happen to us, is either they're telling you one thing, but really they are trying to solve for another, which is often to do with divesting out, leaving the organization. So, I think it's really important when people are talking with people like us that they are super clear around why they are wanting a private equity partner and what they're solving for. And more often than not, it's an aspiration of scaling and growth and some sort of self-actualization, or building out of a quality of service and solving a human need in the market. But within all that, there's all these personal goals that need to be sort of articulated, so that we understand what we're working together on and for. So I tend to find that's probably where those sorts of things kill a
Yep.
deal. The other thing that kills deals, and it gets very fundamental, but it's always the understanding of people's financial positions in the business. We earlier this year looked at an organization. They were a very large, circa what we thought was a $500 million enterprise business, owner led, no intermediaries, proprietary generated opportunity, and they, for whatever reason, just weren't across their financial information. And so we tend to take a hand on a heart approach. You're telling us information. We are basing our view on value and structures based on the conversations and that we're getting. Then once we've signed a term sheet, then we sort of lean in and start doing our due diligence programs. And, that program actually revealed through a variety of reasons that the financial earnings of the business were some, call it, equivalent to about $80 million enterprise variation.
Wow.
So the business sort of dropped from 500 to 420, and subsequently, the owner wasn't so excited anymore. Very grateful for the insight that he received on his business, which we were able to provide to him,
Yeah.
and left with him. But that, I think Dennis mentioned it earlier, that ability to do a little bit of preparation before you actually invite people like us in can make all the difference, in terms of expectations and outcomes.
And unfortunately, the business owners a lot of the times hide the facts that always come out. In case,
Yes,
if you just outline the
Yeah.
issues and how you're solving these issues, then that's never a problem anymore. Like
that's right. I know.
it's like crazy. Like, don't hide the fact that if there's a litigation, it's fine.
Yeah.
We can work
Yep.
around it. Like, I mean, like, they're gonna
It's
find out.
it's so true, Dennis. Like this game is very much about just complete candid honesty. Like
Absolutely.
and you got to remember that we are investing mum and dad's money. Our LPs, our investors are superannuation funds, pension funds, endowments, high net worth family offices. These are people. These are our constituents. That we are sort of custodians of their
Of
capital.
course.
So we take a very thorough approach to making a commitment, to ensure that it's the right commitment. And again, to give you some quantum to that, we, on a first pass, we probably see somewhere in the order of about 250, 300 opportunities a year that come to us through a blend of proprietary and sell side. We'll waterfall that down pretty quickly, but probably about 12 to 15% of that actually go through some sort of IC diligence program. So, you're talking, mid-teens of companies, and then, we'll do maybe 2 investments. So,
Yeah.
and where most of them fall over is either through this financial process, where we get into the weeds of the due diligence on that, or there is some sort of what we might call sovereign or regulatory risk that we see coming down the line that we just think is going to be a negative impact on the business and its growth, and therefore we just don't want to be there.
Yeah.
But the financial piece is, by and large, the largest reason why these things fall over.
Yeah, that's why in due diligence we always start with financial side of it. If
Totally.
financial don't work,
Yeah,
Nothing else is gonna work.
that's it.
Like
So
this.
a business owner needs to really get across their information and understand their business from the inside out.
Yeah.
Mm.
What is that equity to debt to debt ratio? Like when you're looking at a deal,
Yep.
where does it needs to fit into the overall model?
Yeah. So we're by virtue of I guess our pedigree or our heritage, we're very low debt guys. So
Yeah.
across the portfolio at the moment, I reckon the debt ratio is probably circa 2 times. So we're very low leverage players. If you look at say the value creation, 100% of value creation on a business in our game, in what we do at Crescent, 60% of that comes from this operational enhancement and improvement piece. So I've got 25 people in my investment team. They're mostly, as I said, this strategy consulting heritage. So they get worked and alongside these teams to help them think through and execute on all these growth and organic growth and growth strategies, and then we put people into productivity, profitability projects. So we're always looking at and thinking about and driving out efficiencies and growth opportunities, or costs out, or automations, or capex programs, or whatever it is, to try and find all the 1% and 2% improvements in the business, so that everything drops down through to your EBITDA level. The next piece that we get out of that growth, that operational improvement, is probably 20%. The next 20% comes from what we call a margin expansion. Because we're getting operational enhancements and improvements, and the business is getting better and stronger, then it should, in theory, be able to exploit that by driving prices or improving bottom line performance. So we get a margin expansion. You might say, let's say,
What do you typically target for that margin? Sorry to interrupt.
well, we'd like, I mean, what attracts us mid teens to 20% on an EBITDA level is an ideal place for us to play. If you're a single, depending on the industry, of course, but if you're sitting down in a high single digits, you're probably in the pack. You're
Yeah.
probably, part of everybody else in terms, there's no great competitive advantage. We always sort of say to people, look, we're looking for three things. We're looking for a high barrier to entry. So what's the moat around your business? What's your IP? What's your strengths? What's your purpose and reason for being that protects you and your business from every other competitor in the marketplace? So that's your barrier. Then we're looking for high growth, because ideally, if you've got a high barrier, then you should be able to exploit that and push for growth, because you're a better than average participant in the market. And then if you've got that, ideally, then what we're trying to find is you know, is the high margin delivery. So it's that whole, okay, so you got your barrier, you're pushing for growth, and then you're capitalizing on it in terms of the returns you're making out of the business.
Well, it
And if you
makes
can
sense.
get that,
Makes sense why
yeah,
you want to. Makes sense why you want to be in the medical, because that's like you just check. I'm just
yeah.
checking it off as you're talking about. So that makes sense for sure.
So that last 20% to get to the full 100 is essentially the arbitrage expansion of value on the business. So 60% comes from operational improvement and development. Then another 20% comes from your margin expansion that you're achieving from that improvement of quality of company. And there's a lot of quality of company improvement things. And then of course the last final piece of the puzzle is your business is worth more money. So it's an arbitrage of value. If you're buying a company at, you know,
Of
seven
course.
times, you might be selling it at 10 times. Now, how you go about achieving that, of course, is that, whether it's buy and build, through bolt-on acquisitions and so forth, vertically, horizontally, it's probably a blend of that plus organic growth strategies. Then it's productivity, gains. Then it's profitability gains through cost structures, automation, capex, technology, AI, etc. And then, of course, then you're thinking about it, how do I govern my business in terms of corporatization, and then the financial structures, the debt piece. So we use debt, coming back to the original question of, along that journey, we'll use debt which is why it's fairly low leveraged, to use for maybe investing in, I don't know, capex programs, factories, facilities, what have you. We'll use it as a debt piece for recapitalizing the business
Right.
and perhaps creating some shareholder value through that process. Debt is used as just one of a number of instruments, but we don't rely upon it as a leverage tool, as on the cornerstone of how we build our returns. Our returns come from this building a bigger, better business. So we worked hard in the teens when capital was low and cheap, and everybody else was sort of leveraging 4, 5, 6 times. But in this current higher inflation, higher cost market, and a higher degree of uncertainty, the last 5 years particularly, this our approaches have served us very successfully. So our companies are not overburdened. When we saw the uplift in rates and the cost of capital going through the roof, and a lot of organisations suddenly found themselves, really struggling with cash and to support their growth or just to support themselves and fulfil their financial requirements. We
Yeah.
didn't have that burden, so we were able to run faster in a competitive sense with some of the sectors that we were in.
What about in terms of, so if we move to then, sort of exit strategy engineering, Peter, how early do you reverse engineer,
Yeah,
the exit when you're buying companies?
it's surprisingly something that the two things that we talk a lot about when we're first getting involved in a business, and as I said, the first one's very much the why. What are we doing? Why do you want to do this? So it's kind of like looking at the foundation of the next 5 years and go, okay, what are we doing? How are we going to get there? What does success look like in its fullness? And then the very next question is pretty much, and then who is the logical buyer of this business? Who's going to want to have this company in the first place? So what are we solving for, both in terms of creating something of scale, and then ultimately who's going to be the participant or the owner who wants to buy this from us? And we've walked away numerous times from opportunities where the invest and build and create a business of scale is all very possible in various sectors. But at the end, we go, but how do we get out? And there's no logical answer. And you can't rely on a listed opportunity. Everyone goes, oh, you can list it on the IPO. But the reality is that's one of the hardest exit options you can ever have for a whole gamut of reasons. So we always tend to think more around strategic acquisitions, industry players who want to buy your business, or potentially, the next tier of private equity that sits above us. And so that preparation starts pretty much from the first month. We create essentially, data room type environments where we are preparing the organization's information, from day dot, setting up board paper designs that actually capture enough information early in the piece that they can be used later in due diligence programs for potential buyers. So we're always beginning with the end in mind, I guess, the old Stephen Covey principle. And it's so helpful because when you actually get to your divest in time, you've got this incredible, pedigree of history of information in the business that we can now pull together in towards an information memorandum and prove it up and make it so much easier than going through some crazy 6 months, piece where you're actually trying to capture all this data and put all your systems in place and all your, your data analytics around your customer sets and all the rest of it.
Yeah.
So it begins early, Nick. I think if your goal is to build a business to sell it, there are many people who just want to build a business and own it and run it for the next 20 years and enjoy the dividends and the lifestyle that it creates for them. But if you're aspiring to build something to exit, then think very hard around who is the logical acquirer.
That's usually my first conversation when I meet with clients, right? Nick, we did this together too. Like my first conversation was like, okay, this sounds great. What's your exit strategy? What do you mean? I'm just trying to buy. Okay, well, why would you do all this?
I haven't even gone through the gate yet. What are you talking about?
Yeah. I'm still trying to build it.
Like this is exactly my first conversation.
It's so true, because if you don't, and look, if you think about it, I think I heard the other day that there's something like 30,000 what they call secondary portfolio companies out there around the world at the moment. So across the world of private equity, 30,000 businesses that are sitting on their books, nearly half of them or more in the last couple of years, that haven't exited yet. I don't know what the percentage will be in terms of success out of that cohort of companies, but I can't imagine it's 100%. So there's going to be a lot of businesses that are looking for homes that aren't going to find them because they didn't think carefully around who they were going to exit to. Market conditions obviously aren't supportive of some of the sectors that they're in. The performance of those companies is lackluster. So and I guess what that highlights is that it's going to become more and more competitive to exit a company. So
Yep.
you've really, again, got to have these barriers to entries. You've got to have these, these high growth strategies. You're going to have, quality leadership teams. There's got to be something that leaves you in that top quartile of performance in your sector, in your space, that makes you special.
Mm.
Otherwise, you know, if you want to build and sell, then you really need to think carefully around what it is you are creating and why somebody else would really want to take it off your hands in the future.
Yeah, that is absolutely the essence of it. You mentioned, Peter. You mentioned about AI, right? You talked about improvements
Yep.
in growth of the company and utilizing multiple things, including AI, as part of a private equity fund that is sizable, and you're dealing with large size corporations that could potentially use a lot of improvements. How are you looking at AI? In the next 3, 4, 5 years? How is your company looking at AI with your deals?
Obviously, it's still relatively early on the curve in terms of the implementation of AI and the various foundation models that are available to you. We're probably, I guess, at the experimental stage with AI, in as much that we are here at Crescent about to press the button on an enterprise program so that we can operate, sort of with the confidentialities of our organization and not have that shared to the world.
Right.
Um, that said, we are certainly internally currently using a lot of various, what you might call, agents to help us interrogate various things, mainly for the efficiencies of time that it gives us.
Mm.
And that's really simple things. We've got an agent that will interrogate our modeling programs to ensure we haven't missed things or that formulas are working on
I like the
spelling
word
mistakes.
interrogate. I like that.
Yeah.
So that's so the analysts are loving that. We're doing simple things from legal documents, agents, and we even have one that helps us book restaurants for the appropriate person for the appropriate tone and all the rest of it. Within our own organisations, we are currently again rolling around, mostly a lot in healthcare. I mean, we're seeing some around radiology. There's some great AI agents that are assisting radiographers in looking at and thinking through, the various X-rays, etc., that they see. But that's very repeatable. We're also probably starting, and all this has only happened, I'll be honest, in the last couple of months. It's
Mm.
been something that we've been playing with, but we are now actively working with our leadership teams to get them to think about how to use this tool to improve the quality of their information. So, not surprisingly, the financial departments are now starting to interrogate, as again that word,
That's
to
awesome.
their P&Ls, their
Yeah.
cost balance lists, and things like that, and look for patterns, look for opportunities. And what we're finding is that it's it's just an incredible. It gives this whole fear that people are going to lose jobs doesn't appear to be presenting itself presently within our operations. What it's doing is it's allowing people time to actually think about and creatively think about solutions or how to use this information that they glean to then make changes in the organization. And what we think is happening on a broader scale is that AI is exponentially, growing in terms of its capability set. In the last 2 years, it's gone from Chat GPT 3 to 5 point whatever, and incredible activity. But the adopting of organizations is on a much lower curve. So
Mhm.
you're getting this separation from adoption and interest to the capability, and that gap is getting wider and wider every 6 months. So what we're trying to do is bring our organizations closer to that technology capability,
It's a
sort of,
great way to describe it. I like it.
and we're always looking for the competitive advantage. We talked about it before. So this is again another opportunity for our organizations. If they can glean out another 1, 2, 3% of improvement by you being closer to that technological advance, then you're ahead of the curve. You're going to get another maybe 1 point or 2 points on your bottom line that might give you another half turn of
Yeah.
multiple.
Yeah.
You know, we've done the same thing in the ESG world. We have a small ESG team here of 3 people who go into an organization and build a 1,000-day plan and help those companies think through and execute on the materiality issues around the environments, and social and governance, to again create better quality companies that we hope will then reflect in the valuation at the end of the day, compared to the others that maybe haven't done the same depth of work that our team has.
Yeah, I like how you're always looking at companies not just from the arbitrage of the multiple of the size, the sheer size of the business, but you almost putting your consultant hat on and optimizing all the processes and operations
Yeah.
within the company. Because the
Well,
1,000-day plan, that's
yeah.
like that's consultant 101. So like I
Well,
and interrogation as well. Like putting those
there's,
together, you're on.
you'll be amazed how many matrices we have.
Yeah, that's amazing.
But it goes back to the fundamentals of who we are and what we do, and maybe to Nick's question around why should someone like private equity. It's like, when you're getting involved in a business at this granular level and adding value and helping management make better decisions quicker through that provision of information and data and support. The benefit of all of that is this valuation piece that we get at the end, which is why we're sitting so successfully in this top decile position presently.
Very true.
If you're just going to wrap a rubber band around a whole bunch of assets and sort of hope like hell that you're buying them at 4 times and selling them at 8 times because you've arbitraged scale, but you've done nothing to integrate it, and the whole thing gets the speed wobbles and falls apart,
Yep.
6 months after you've sold it,
Yep.
that's when the PE guys get the bad names, and that's when
exactly. And I tell the clients that we work with on the roll-ups, you can't sell 5 companies. Like you have to sell one. So
Right.
you
Yeah,
can have
yeah.
5 companies. like you got to sell one company, one united company. You can't
Absolutely.
be 5. So
Yeah.
I have to ask you. I'm using this time period to interrogate myself, but I have to ask you this question, because this is the frustrating part of roll-ups and buy and builds and private equity and M&A in Australia, New Zealand versus the United States. There's no data available on transactions in Australia, from what I can see. Like in United States, I have 3. I'm subscribed to 3 different platforms where I can. Yeah, they're not all whole accurate, but on average, I can see the tendencies in particular indices when I'm making a decision. And in Australia, I could never find a database that has any good source that I potentially can subscribe to. So
True.
for me, if I'm analyzing healthcare or home services, it's hard because I don't have the data. I can only see the data of what margins or what the ratios should look like. I can compare a company and see if it's a good company, but
Sure.
from the projection of multiples and arbitrage, it's hard to predict. Do you have a workaround that, Peter?
Unfortunately, not really. I mean, we just, like you, we just try to find and collect comparable information from multiple sources. Um, I guess because we do so much in healthcare, we've now built up such a library of knowledge and a depth of experience that we sort of just know intuitively, within reason, what valuations need to reflect to achieve that. It is fair to say that over time, these valuations have gone up. When I first started this game nearly 20 years ago, the average multiple was like a 6 times. We did a dental roll up. We were buying those dental practices for 3.5 times. Today, those same single site practices have virtually doubled in value because of the combination of competition and need. And likewise at the other end, the average multiple, I think today sort of is probably around 8s or something of that nature, across an aggregated sort of view. You just know there's no silver bullet in this, I'm afraid, Dennis. There's no site you can go to get, because everybody, we're all the same. We all tend not to promote our
Of
information
course.
and things like that. And so you're relying heavily on
It's all close to the heart.
the public markets, and at the moment, the public markets are no real
They're not a
measure
good.
of value at the moment at all, because they're quite irrational.
Yeah,
And a lot of
absolutely.
that's just the quantum of capital looking for a home. And so, these pension funds and superannuation funds, etc., are all just piling in on a smaller cohort of companies to try and put their money to work, and that's why we're getting these irrational valuations on assets out there in the marketplace. So normally, in the old days, a private company would be a discount to liquidity on a public company, and
Right.
you might take 2 turns off the back of that, and that was your number.
Right.
Doesn't stack up anymore.
It doesn't. I mean, we look at yeah, the equity to debt ratio. We're figuring out what that liquidity is going to look like. We're
Yeah,
looking at all the different data that is available. So like, but we piecing it together, which takes obviously a little bit
yeah,
longer.
yeah,
Do you
yeah.
ever compare it to U.S. markets at all? Do you ever feel
Um,
like
we tend to do over here, I'll be honest, is that we tend to search the US to see what investment themes are playing out,
mm,
because we tend to feel that you guys are running a few years ahead of the Australian marketplace. And obviously there are, various economic dynamics that change, particularly in healthcare. But we do try to use you guys as a barometer of where maybe things are moving to, and what can we get ahead of that curve here and do something about it. From a valuations point of view, I guess we look to the market where we think there's an opportunity to divest it into. So we'll think about that from that point of view. Um, from a guiding of valuation here in Australia, we probably don't really think about it, because the markets are, to your point, so different in structures and supply demands, etc., that it's hard to correlate, the valuation of a radiology group in,
right?
in Ohio to radiology group in Victoria. It just
Right.
doesn't correlate.
Outside of medical, I know you're specialized in medical, and I know Nick is all in medical. But outside of medical, what other industries, if anybody's looking to start off from, ground floor on this private equity buildup, what other industries do you find Australia has a pretty interesting
Yeah.
opportunity?
The next biggest bucket in our world. So at the moment, just due to a variety of reasons, there's sort of four primary sectors that seem to be doing quite well in Australia at the moment from an M&A point of view is healthcare, surprisingly.
Hmm.
Um, Professional services.
Yep.
Australia has an enormous financial management
Yep.
industry, and so there's lots of things wrapped around the professional services
We're
sector.
doing a roll up in that one right now.
There you go. Technology.
Yep.
And technology is more of a big horizontal, but when you think about it, again, I'm sure it's the same in the US. Productivity gains for organizations when labor is, your biggest limiting factor in terms of cost, have to be found elsewhere. And so
Mhm.
technology is becoming more and more part of that solution, whether it's a platform or a SaaS or a software or some sort of AI deployment or what have you. So we're seeing that play out much stronger now. No surprises there. And then your last piece of your puzzle is pretty much what they call the industrials. So over here, that really correlates to construction and infrastructure cycles, and a little bit of the mining industry,
Right.
but particularly construction and infrastructure. And at the moment, they sort of obviously are heavily supported by the government, particularly the infrastructure piece. And then what we tend to look for in those themes are the what we call the picks and shovels guys, the guys that are selling the bits and pieces into those
Right.
themes and riding and then they're quite cyclical, so you got to kind of
Yep.
pick your moment. Discretionary stuff at the moment is really hard. The consumer is under a lot of pressure at the moment over here from a financial perspective. Retail outlets, that sort of stuff is a bit tricky. So we tend to avoid those at the moment. From an M&A point of view, I guess. We tend to do in our industrials investing piece. There's always vertical and horizontal opportunities to build out a larger enterprise business. Professional services, absolutely. There's such a plethora of various organizations that can be bolted together to create a bigger accounting group, a bigger legal group, a
Right.
bigger financial management group, etc. Obviously, healthcare is just a never-ending opportunity in our mind for a whole bunch of reasons.
Mm.
Um, but look, we've seen, the veterinary market, which I guess is quasi-healthcare, is certainly, another market that we've seen a lot of activity on over here at present. A lot of the US and UK guys are over here buying up
Oh yeah.
veterinary
Oh
practices.
yeah.
Um,
Huge roll up rush, gold rush.
yeah,
Yes.
yeah. Australia's had again, due to the funding models, has had a big push of care to the home, So you're seeing, a large build out of organizations that are providing services to the home at a variety of levels. And again, that's, the government's actually really trying to encourage a more aggregated approach to build out some big players that can actually deliver higher value quality services. So we're seeing a bit of a rush to the doors of buying up allied workforces, and things of that nature. They're the main sort of sectors that seem to be sort of rolling quite heavily here at the moment in terms of activity. If I look at my pipeline, it's sort of, I guess it's self-reflecting of our own portfolio. So a big chunk of it's healthcare, and then there's a couple of industrials. I've got about 3 or 4 technology companies that I'm working with at the moment. A couple of, we're having a project in professional services at present that we're about to initiate. We're not looking at probably a whole chunk of the market.
Right. There's so many opportunities out there. I like
Never
the
stop.
fact that you guys are concentrating in one direction, and I think it all makes a lot of sense.
Well,
Um,
what we find, and the reason look, the reason you can no longer be just a generalist anymore in private equity
right.
land. You've got to,
Agree.
Australia's not big enough to be, we can't go all in healthcare because the depth of the market isn't big enough to support the capital. But you've got to be good at something.
Of course.
So whether it's health or technology or whatever it is, you've got to, as a private equity firm, you really got to have a bench that you can stand on and say, this is who we are, and then we do this other stuff as well. Because your LPs, the people who give you the capital,
Right.
are very much wanting to see, well, if I'm going to give you money, what are you going to do with it? And how am I going to, if I'm going to give you $1, how do I get $3 back? And do you know what you're doing to give me that return? And what we're seeing now, of course, is it's this sort of oil and water moment where more and more funds are becoming defunded because they don't have any expertise. And so the LPs are giving more money to fewer people as opposed to just betting all the horses in the race.
Yeah.
And so
Makes
it's
sense.
important.
Yeah. And
And that's the same, and we're a business. So our business is to do what we do. So everybody else out there needs to have the same view, which is, what do you stand for? What makes you special that people want to give you their money? Whether it's a consumer, a client, a patient, the government, or an investor,
That's probably a great point. And maybe as a final, we've gone plenty of time here. I hope that's okay with you, Peter, but great conversation. But maybe as a final point, what does a founder or a business owner need to do to attract? And we've probably covered a lot of this, but just as a summarising statement as we finish up here, but what do they need to do to really look to attract a firm like Crescent?
The honest truth is, if you're looking for private equity capital, first, you know, like doctors, private equity practitioners come in various shapes and sizes and abilities. So I guess try and do some desktop research to work out who's who in the zoo, and if you're really wanting to be proactive, give us a call, sort of thing. Reach out, but as opposed to that, if they are trying to make themselves attractive as a target, normally what happens is people, from my experience, most people aren't necessarily directly thinking about wanting private equity. They just get about doing what they do. They're scaling. There's a degree of momentum that sits behind that. They get to, because of that noise that they're creating or that momentum that they're building. We tend to find them more than they find us. But as we said earlier, that understanding of your business, your operations, as to what levers you've got to pull to drive growth, and then making sure that you've got robust financial information. It doesn't have to be, I don't know, CBA quality IPO, books, but it just needs to be that you understand, what's happening inside your business and those sorts of things. And then private equity is always about backing people. We back people. We back people's aspirations and dreams more than we back a business. And so I guess having within reason, an articulated view of what you're trying to do and know how you're going to kind of do it is really helpful. We can critique a strategy, we can enhance a strategy, we can develop a strategy with people, but it's not our strategy that we are overlaying over on a business. We are challenging people's views and maybe refining some of their thinking, or maybe even narrowing their focus so that it's not too broad. But at the end of the day, we're starting with their kernel of an idea more so than ours. So I don't know if that's answering the question, but it's certainly sort of
100%.
articulating a sense of, as an owner of a business, you can't be loose around what you're doing. You've really got to have something, a little bit of magic about what you're about, that people like us are a spinnaker on their boat. It's just going to accelerate the growth opportunity. It's going to put distance between you and your competitors and get you to the destination that you're seeking sooner. And hopefully the time value of that money then means that you've got other options in your life that are that can support the vision that you're building.
Yeah,
I
great
mean,
answer.
not all private equity groups created equally, right? And at some point in life of a company, you need to bring the team on board. You either need to spend the money and test and see how things are and figure
Yeah.
it out yourself, or you need to
Yep.
bring the experts. Because
Yeah.
Jeff Bezos or Elon Musk, they don't own 100% of their companies. They own a
No.
small percentage of it because they were
Yeah.
smart to bring the people and bring the money when
Sure.
it's needed,
Sure.
and it doesn't work any other way.
I can point to many examples across our portfolio where an founder's 30% or 40% was worth way more at the end of the day than 100% of what they had at the start.
Yep. I
Yeah.
always recommend rollover equity. If you have an opportunity to rollover equity with
Yeah.
people that you trust
Yep.
as your partners,
Yep.
1,000%, it usually works out for the best. I always recommend
Yeah.
rollover equity.
Yeah. And it also, the other aspect that people don't consider, I find, is that by selling down some stake in the organization and creating some liquidity for yourself, some value, it actually de-risks your
De-risk, yeah.
home.
Yeah,
And then that often inspires or fires back up what I call the boyish enthusiasm back into the business, because you're no longer got personal guarantees. If it all falls over, everything's going to be okay for you and your family. And what we're now doing is actually we're now building a business. We're not worrying about creating security over my house. And so
It's actually a mechanism to clear some of that headspace and get back to that creativity.
Yeah,
Probably sparked it all in the beginning.
it unshackles
Yeah,
a lot of
100%.
original thinking.
yeah,
Yeah.
100%. Peter, we've been interrogating you for an hour. I can't thank
Yeah,
you.
no, it's an hour. I can't believe it. I have to go to the day job.
This has been amazing. You've been a great guest. I really appreciate you joining the M&A Blueprint, or M&A Blueprint Interrogation, as we should now call it.
That's right.
Hope to have more conversations on here. If you
All
guys found this helpful, if you found this useful, leave a comment, subscribe. Let us bring Peter back for more interrogation to come. I have maybe 200 more questions I need to ask, and I didn't get a chance this time around.
It's been my pleasure, guys. It's been an enjoyable conversation, and hopefully there's been a few little gleams of gems or something in there that have helped.
No, it's been fantastic, Peter. Really appreciate your time. Great to see you, and have a fantastic day.
All right, thanks, gents. Appreciate it.
Cheers.
Bye now.